It's very common for people to put retirement money into syndications, money that maybe is in a self-directed IRA or 401k. And that's perfect for development opportunities because people who have money in retirement funds, they're not going to use it in the next 3 to 5 years. Somebody who's 40, they're not going to draw that money for 25 years. So they're in their 60s. So it doesn't matter in a sense whether there's cash flow or not, because they're not going to touch that cash flow anyway. What they really care about is overall return and a good risk profile.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Thank you to everyone who is a dedicated listener to the How to Scale Commercial Real Estate podcast. Just want to give you a heads up that today we had some audio issues on actually 3 or 4 episodes that we recorded in a row. They were such good episodes, and the guests were so kind, of course, to share their time and insight with us that I couldn't ask them to re-record it. So we're going to go ahead and publish these episodes. I am aware of it. The audio is not what I like to put out, but running a daily show, at some point in time, we're going to run into a hiccup along the way. And today is one of those days where I get to share my mistakes and hiccups right along with you. But again, it's a great episode. You can hear the guest a lot better than you can hear me, and it's just part of what it is that we do. Nevertheless, here it is. Thanks so much for tuning in. Certainly appreciate it. Joel Fine is a full-time real estate investor, syndicator, and land developer based in Austin, Texas. He's a general partner in 1,100 doors, a limited partner in 12,000 doors. He's a principal also in ground-up development projects spanning 157 acres in Central Texas. Joel, welcome to the show.
Thank you so much, Sam. I appreciate you having me on.
Absolutely. The pleasure is mine. Joel, there are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Wow. Okay. That's a lot to cram into 90 seconds, but I'll do my best. So I studied in college to be an engineer, was an engineer, and then a project manager for many years, worked in high tech in Silicon Valley, started doing real estate as a side gig, bought a house in Texas, really as a way for my wife and me to plant a flag because we knew we were going to move to Texas some years hence. So we bought this house as a way to sort of begin that process and then caught the bug. That one house was my gateway drug. And I did a lot of real estate after that. Started buying in Ohio, bought some duplexes and triplexes and quads, looking for cash flow, not so much appreciation. Also started learning about multifamily and how to scale up using syndications and partnerships and so forth. And once I got to understand that better, jumped over into that realm, started investing passively in other people's deals on the value add multifamily side and a little bit on development side, caught that bug, and then started doing my own deals. So since then, I've done about, I think 11 deals total that I've sponsored. I'm actually up to 1,200 doors, not the 1,100 I gave you in my bio, because we just closed a deal in downtown Austin it was 91 doors, so not quite 100, and still rocking and rolling. Got a bunch of deals in the pipeline. That
is awesome. I love that. It sounds like you have a quest for ever improving your craft.
I do, yeah. And along the way, by the way, I moved. I was in California in my high-tech career, did move to Austin, Texas about 2 years ago, and really happy with that move, able to invest locally in Central Texas and watch it just blow up here as people move in from out of state. And, Austin's just a great place to do business.
It sure is. Yeah. I mean, Austin is booming, as you well know. I don't have to tell you that. I'm curious. I saw this 91, you mentioned this 91 door deal you just did. How are you finding and securing opportunities in Austin, Texas? I mean, you say 91 doors in what'd you say, downtown Austin? Was that what you said?
Yeah. It's in a neighborhood called Hyde Park, which folks who know Austin would know that's basically next door to downtown. It's about maybe 1.5 miles to 2 miles from the university, from the state capitol, really from the heart of downtown. So yeah, to answer your question, how do I find those deals? Through great partners. I've networked a lot, met a lot of great folks, made friends with people, and just connected with folks who have the relationships with brokers, with sellers, and tried to find ways to make myself of value to those people in closing deals. And through that, have been able to become part of deals. I'm not solo on any deal that I do. I've got partners on everything, and I'm perfectly happy owning a minority interest and being part of a deal that I think is a solid business prospect. So that's how I do business, and that's how I've been able to do as many deals as I've done in the time I've done them.
Right. What opportunity or what value are the sellers overlooking? Let's talk about this 91 door deal. Like, there's clearly an opportunity for you guys to increase the value of this property. What are they leaving on the table that you guys say, man, I think we can make that work?
Yeah, so it's actually, this particular one is two properties about, I don't know, 3 or 4 blocks from each other, 50 unit and a 41 unit. And out of state owners, they're scaling up to bigger stuff. They're moving a lot of their assets out of Texas to other locations. Just really weren't paying a lot of attention to the property. It's in decent shape, doesn't need a lot of renovation, but by doing some rehab and by focusing a little bit more on bringing rents to market, we think we can create a lot of value there. The rents are pretty far below market. Previous owners were content to have pretty low turnover on the tenant base and didn't really push things the way they could have. So it's understandable. It can be a little bit risky to raise rents to market because you are going to lose some tenants. You might make some tenants a little bit upset. But the fact is that the market is moving. We've got inflation. We've got high demand in that part of Austin and really in Austin in general. And so there's opportunity to create more value from assets from folks who maybe have owned the assets for a long time and don't really have the energy to put into them.
Are you guys managing that in-house, or do you have third-party management for that property?
It's third party.
Okay. How did you guys secure? Do you own other assets nearby where you can kind of aggregate and have economies of scale with property management? Or did you find somebody that said, hey, I'm good with 91 doors across, 4 or 5 city blocks?
Yeah. So in this case, we now have 6 properties in Austin. And we're working with one particular property manager who manages all 6 for us. These 2 are on the smaller end. We've got a 110 door and 126 door, maybe 4 or 5 miles away. And those are a little bit more traditional in the sense that you can have on-site leasing agents and maintenance folks. Once you get over 75 doors, it's a little bit more scalable. So, we're going to have to tune our management model a little bit to make sure that what we're doing makes sense for properties that are relatively small in the scale of value add multifamily. 40 doors is too small to really support an on-site, full-time staff. So we're going to have folks that, either do on call or maybe part-time, maybe a few hours here and there, certain mornings of the week, that sort of thing. So we'll work it out with our property manager to do something that makes sense.
Yeah, I guess that brings up a really interesting kind of conversation or topic for me is how do you make sure that when somebody wants to see a unit or they are interested in leasing an apartment from you, that they are responded to quickly? Like, what's the process for somebody to make sure you don't have leads fall through the cracks?
So that's really in the domain of our property manager. They own that task to make sure that they've got the support system and the infrastructure to properly respond to inquiries and, to turn leads into showings, appointments, and ultimately to paying tenants. We've got metrics that we track week by week, to see how many leads are we getting on each property, how many of those leads turn into appointments, how many of those appointments turn into visits, and so forth. So we track those, but we leave it up to our property manager to make sure they've got the infrastructure. And there's a lot of ways to handle that. Technology can be of some assistance, right. Making sure you have a good website, making sure you have a good presence on other websites like apartments.com. Sure.
So one of the questions I have for you is about ground up development. I know you've spent an inordinate amount of time, learning and kind of developing your craft over the years and mastering what it is that you're doing. Ground up development is something that most of us, myself included, are fairly not afraid of, but it's something I just don't know that much about. How did you educate yourself? And then how did you know when the right project came along that it was the right project for you and then pull the trigger?
So I'll go back to maybe a theme of my real estate career here is I found great partners. And that was my entree into that part of the business, ground up development. So met somebody at a meetup who had been doing subdivisions for a long, long time. In fact, they were part of a family business that had been doing it for a couple of generations. So literally decades of experience doing subdivisions. And what I mean by subdivisions is they would take, let's say, a 50 or 100 acre parcel of land, slice it up into maybe 5 acre ranchettes, put in some roads, put in utilities, and then sell off those ranchettes to individual owners who maybe wanted to build their own house on it or just have a place to go way out in the country. These were fairly rural places for the most part, but that was their business model, is they would take very large tracts of land and carve it up into smaller tracts of land. So found this a couple who lived not too far from me who was doing this. But they were doing it basically with their own capital, just whatever they could afford to take down. And with my experience in value add multifamily, I had been started being exposed to capital raising and how to partner up with folks who could be passive investors in deals and help me to scale up. You know, if I can afford, let's say, a $500,000 property on my own, I can get investors and buy a property that's 10 times that size and share in the spoils. You know, share the profits with my investors, and all of us can benefit from that. And so I brought that to bear on that model in subdivisions, and then later in ground up development with this couple that I'd met. So rather than just buying, you know, a few acres here and there, we started scaling up into bigger things. So first project we went after was a 20-acre parcel in a town just south of Austin called Lockhart. We're in the process now of getting that parcel rezoned to be a higher density use, and we're aiming for a 200-unit townhome community there. I got another property, 15 acres just east of Austin, right by the Tesla plant. We're looking to put a 265-unit apartment complex and a 40,000 square foot retail center on that land. Then we've got another property, 35 acres. We're looking to subdivide something like 215 houses. That one we'll just sell off the lots to builders. We won't do the build. So there's a lot of different ways you can carve up that task of ground up development. Some people just do the entitlements and then sell off the land once they've got it legally entitled and permitted. Other people actually do the builds. So we're exploring different business options as we go. We've got different exit strategies that we can pursue as we get further into these projects, and just having a lot of fun, you know, exploring and learning.
How do you handle the finances on those various projects? Because none of those are producing an income right now. Buying it, you're saying, hey, you know, it's a 20-acre parcel. We're going to turn that into, and I can't remember what you said there, a 200-unit townhome, I think, maybe development. How are you projecting the hold period, the finances, the development risk from a refinance side, some construction loans? I mean, there's a lot of moving pieces in there. So can you kind of break down, I guess, how you even model that?
Yeah, so there's different ways to model it financially. There's spreadsheets out there that can help with that. But what we do is we break it down into phases. So we typically have a land acquisition phase, an entitlement phase, and then a construction phase. And sometimes the construction phase can be in two parts. There's a construction of the infrastructure, meaning the roads and the utilities. That's the horizontal. And then the construction of the buildings, that's the vertical. And any one of those pieces provide an exit opportunity and a potential for a very specific financial model. So, for example, if we acquire land and entitle it, get it permitted, now we've got a more valuable piece of land because a builder can come along and build to the specifications we've put together. They now have the permits in place. It's been largely de-risked, because one of the risks of construction is whether you'll get permission to build what you want to build. And so by doing that, we're adding value to the land. We're making the land more valuable. And so we can model that. We can say, hey, projecting forward, if we can get this land entitled, if we can get the permits, apartment units in this part of Austin are, permitted apartments pre-built are worth, let's say, $25,000 per unit. And so if we multiply that across the number of units, this is the value of the land after we're done. Now let's see what the land will cost us. Let's see what the entitlement process will cost us. There's a fair amount of work that goes into that, and a fair amount of expense, not just in terms of buying the land, but also hiring civil engineers, surveyors. Sometimes you got to deal with figuring out if what the condition of the soil is. So you hire geologists. You've got architects. You got to plan out a lot of things about the property. Maybe, you got to put together a site plan that makes the fire marshal happy, enough parking, structural integrity, how many floors you're going to go up. And if you go up more than so many floors, you've got to make sure you've got the right kind of materials that can support that structure. So all of that takes time, takes effort, which translates into money for the people who are bringing their expertise. So again, you figure out what that's going to cost, build that into the financial model. So it might be that, let's say the land is going to cost $2 million. The entitlements are going to cost another million and a half. So by the time you're done and you've got what's called a paper lots or a paper design, maybe you're into it for 3 to 3.5 million, but you can make a claim that now the land's worth 6 to 7 million. So you've created a lot of value in that process. And so you put that story together for investors. You tell your passive investors, hey, this is what we're going to do. This is our business plan. This is the value we're going to create. And based on that value, here's the returns you can expect. Now, what I do is I make sure it's clear to my investors that there's risk here. Making some guesses about the future in terms of the value of the land and the risk of problems along the way. And so, given that risk, I'm compensating my investors for that risk with good returns. And so you just got to find the right kind of investors who have patient money, people who have money where it's okay not to have cash flow for a few years, but then you get a nice big pop at the end from the appreciation. So in particular, it's very common for people to put retirement money into syndications, money that maybe is in a self-directed IRA or 401k. And that's perfect for development opportunities because people who have money in retirement funds, they're not going to use it in the next 3 to 5 years. Somebody who's 40, they're not going to draw that money for 25 years. So they're in their 60s. So it doesn't matter in a sense whether there's cash flow or not, because they're not going to touch that cash flow anyway. What they really care about is overall return and a good risk profile. So that's the kind of money that oftentimes invests in the ground up development projects. It's money that's fairly patient and can tolerate the level of risk we've got with our projects.
Gotcha. I think that's really, really cool. When you look at these projects, is there a preferred exit that you have? Do you say, man, I know plan A is, get it a paper project, get it all ready to go, I think is how you put that. Is there any desired exit for you, or is it, we'll just keep moving ahead and then when the exit makes sense, we'll take it?
It depends on the project, but I like projects where there's multiple exit opportunities because that gives us a way to mitigate the risk. Just in case, let's say, construction becomes difficult in a particular period of time or for a particular market, then we can back out of the deal, sell the land to somebody else who's willing to deal with those headaches once we've got a plan in place and we've done the entitlements. On the other hand, we may choose to go ahead and do the construction if conditions warrant. So it's nice to have multiple exit options. I do like the early exits when they present themselves and are lucrative because then you get a nice velocity of your money. We've got a deal that looks like we might be able to exit our investors out within about a year and a half, maybe 2 years. And we should be able to get at least 50%, maybe 75% the way things are looking. Again, there's risk. It's not a certainty until we're done, until the money's in the bank. So things could go haywire in a lot of different ways. But right now, that project's looking very promising. And, if people can do nearly double their money in a year and a half and then turn around and put that in the next opportunity, the next investment, that's phenomenal. That's exciting to us. It's a way we're creating value, not just in the land that we're flipping to somebody else after we're done entitling, but we're also creating value for our investors in giving them a great return on their money.
I love it. Joel, if you could rewind the tape, however long you've been investing, what's it been? 5, 7, 10 years, maybe?
About 5 years.
5 years. What is one thing you would tell yourself to do differently, maybe that you would do differently if you could go back?
Well, so in that hypothetical, you said I can rewind the tape to when I started investing. I'd rather rewind the tape further and start investing earlier. So rather than waiting until I think my first investment was around when I was 50. I would do it, when I was 25 or as young as possible, just get started and get into it. Early on, when I was living in California, everything in California is relatively high priced, especially when you look at the price to rent ratio. And right. I did some analysis way back in my youth and determined that there's really no cash flow in California real estate. It's all about the appreciation. I mean, in hindsight, the appreciation's been just amazing. But when I was looking forward, projecting what I could do, I said, I don't want to count on appreciation. I don't trust it. Without cash flow, this investment just doesn't make sense. And I projected. I said, hey, I'm evaluating California real estate. I guess that all real estate markets must be like that. So real estate's just not a market that I'm interested in. I'll put my money elsewhere. And in hindsight, that was dead wrong. I should have invested either in California or elsewhere for cash flow. And so that's what I would change if I had a Wayback Machine, is I'd get started in real estate much earlier.
Start earlier. Absolutely love it. Joel, thank you for taking the time to come on the show today. I certainly appreciate it. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
Awesome. Well, thanks for asking. Yeah, I've got a website. It's called lakelineproperties.com, LAKELINE, Lakeline Properties, all one word. People can go to that website and learn more about me. There's a contact us page, or they can just email me directly. I'm joel@lakelineproperties.com. Always happy to talk real estate. Folks who have money they want to invest, folks who have partnership opportunities. I just like to get to know people and get connected with folks who are in the business.
Awesome. Joel, thank you for your time today. I certainly appreciate it.
My pleasure. Thanks for having me.